Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500. We have a lot to cover in this episode. We're going to be talking about in this video exactly what we expect to happen in the next few weeks, where we expect the SP 500 to go after this period of consolidation, and what we think the big opportunities are in the market right now, taking into account the fact that we're ending the current economic cycle, right? This is a chart of the 2-year bond yield, and you can see we're rapidly reaching resistance here on the 2-year yield. This typically happens near the end of an economic cycle. It happened in 2000, it happened in 2007, it happened in 2018. So we're clearly getting closer and closer to a recession as credit becomes tighter. There's more incentive for people to save. And so you tend to see a period of economic turmoil follow this. In fact, we can take a look at the stock market in this type of environment, and you typically see a large top around a year after you have a top in the 2-year yield, right? The 2-year topped in May 2000. Here, the market topped around 6 months later. Here, the 2-year yield topped in July 2006, and the market topped in around October 2007. Here, the 2-year yield topped during this correction, and the market topped around a year later. So we're really getting into that part of the cycle where things are getting risky. We're getting towards the end of the bull run, but returns can also be massive, right? In this period, this is where the stock market makes the largest rallies in the shortest amount of time towards the end of big bull runs. Now, the goal of this video is to really show you guys why the majority of people do not understand what the Federal Reserve is doing and what they're going to do. And I think a lot of people misunderstand what is going on here from a technical level, what this rally means, and what type of scenarios we could see in the near future. So if you're interested in following these crazy markets with us, make sure to click on that subscribe button if you have not already. If you enjoy this video, don't forget to smash the like button. And now, without further ado, let's get right into it. All right, now the first thing I want to talk about is really put this into context. Now, we've been talking about this for a few weeks, but what's the primary driving factor behind this correction in the stock market? What was the primary reason? It wasn't Ukraine, it wasn't Russia, it wasn't commodities. No, it was tightening. It was Federal Reserve tightening. In fact, we can put up the VIX on this chart just to show you guys what I mean. The VIX bottomed here at the beginning of November. This is exactly when the Federal Reserve came out and said that they were switching from easy money to tight money, and they started to get hawkish in November. That is when you started to see the VIX, so the volatility of the SP 500, go up, make higher highs, higher lows, and along with that, the market started to go down. So everyone is still concerned about 7 rate hikes coming in 2022 and the fact that the Federal Reserve is tightening into a weakening economy. So I'm going to show you a few charts here that are hopefully going to give you an edge against the 90% of people out there that are talking about this and that have absolutely no clue what they're talking about. Now, the first way I'm going to prove my point here is just by showing you this chart of the yield curve. This is the 10-year minus the 2-year. Again, we've discussed this before. This is the boom and bust cycle. Now, when you get closer and closer to that zero line, that dotted line that I put here, that's when you know that recession risks are increasing. And guess what? The Federal Reserve knows this, right? Central bankers aren't idiots like many people out there seem to think. They're actually very smart individuals, and they know that if a recession is coming, they shouldn't be tightening monetary policy. And I'm going to show you exactly what I mean by that. I put vertical lines here on this chart every time that the yield curve gets closer to zero. And I've done this going back to 1989. And let's see what the Federal Reserve has done with their monetary policy. Every time that you have this vertical line, every time that you have the yield curve get closer and closer to zero, let's put up the federal fund rate, and you can see every time it's towards the end of a tightening cycle. The Fed has already tightened quite a bit, and then you have a yield curve inversion and they finish their tightening cycle. You had the same thing here in 1994. Federal Reserve tightens, and then yield curve gets close to inverting and they end their tightening cycle. Again here in 1998, as yield curve gets closer to inverting, they actually announced that they're going to lower rates. And again in 1999, it's just before they end their tightening cycle. In 2006, just before they end their tightening cycle. In 2019, just before they end their tightening cycle. Now, why am I so emotional about this? Because I'm seeing a record number of people going online on interviews, on podcasts, misleading investors into thinking that this is somehow the very beginning of some major hiking cycle. That's not at all what this is. It might look like it because we're still at zero and we haven't typically had the tightening cycle leading up to this yield curve inversion, but we're getting to the end of the tightening cycle. Now, the other chart I had didn't have data going back into the 60s. So I'm going to show you on this chart here because I know I'm going to get a lot of comments saying that the environment now has 8% inflation. And so you can't compare it to anything on this chart. So let's go back to the 1960s when you had inflation at around 7.5%, right? Inflation rate in 1969 was near 7%. So comparable to the levels we have now. Well, look at this. You had a yield curve inversion in May 1969, and you had a yield curve inversion in May 1973. So let's look at the federal fund rate at these moments in 1969, May 1969, that was the end of the tightening cycle right here. And in July 1973, so a couple months after the yield curve inversion, that was the end of the tightening cycle. They began to lower rates. The point I'm saying is that when you have a yield curve that's getting closer to zero, central banks tend to stop monetary tightening because they do not want to tighten into a recession. And they will apply this concept regardless of whether they've tightened leading up to that moment or not. What do you think is going to happen to the market when they realize that the Fed isn't going to tighten nearly as much as what everyone's been expecting? The market is going to go on a massive run. And there will be a lot of people who took out their money out of the market because of the Fed tightening, and they'll be stepping back in when the market is back to all-time highs. Now, again, that doesn't mean that the market is going to go straight up from here, because these types of things, these type of switches can take time before it materializes into a breakout. Right, in 2018, you had the yield curve get closer to inverting throughout this entire period, but you still had volatility. In fact, you had quite a large drop. I don't think we're going to get that. I don't think we're going to get a massive breakdown, but could we come back and retest this big level of support here and make a type of head and shoulder pattern like this? You know, that is definitely possible. But I think the larger part of the rally is going to be when the Fed is actually starting to really get dovish, and that's not the case, and that could still take a few months before it materializes. Now, I wanted to show you something very important that we posted last week, and that's the fact that the market has been showing incredible early strength. We've had 4 consecutive days on the SP 500 with more than 1% gain, and that's only happened 1, 2, 3, 4 times over the last 50 years. In fact, since 1957, it's only happened 4 times. And this shows you the type of returns that you can expect in the months ahead. It tends to give extremely great returns, at least 3-6 months out. You can expect the stock market to be higher. And I can tell you, at the bottom here, you can find one YouTube channel, one Twitter account that was calling for a massive rally like this. At least I didn't see anyone comparing the NASDAQ 100 in 2022 to March 2020 like we did in this premium article. Just a beautiful contracting price action with bullish divergence on the RSI. You click that play button, and you can see we've had a massive run. But one of our members actually pointed out that following those 4 strong days, you often had a pullback, giving back up those 4-day gains. And that's why I say you can't think in a straight line. The market doesn't just go up straight like this. You could definitely see a move retracing part of that move up that we've seen before you get that strength. That doesn't change the fact that looking forward 6 months, you've got a median gain of 17%. That is just absolutely monstrous. And this is exactly why we post articles like these. We make a complete, comprehensive overview of everything that we're looking at right now, where we look at different setups, different ratios in the market to tell us where the opportunities are, what the current sentiment is, what's the current macro environment, what's the Fed going to do based on growth, inflation, the economic cycle. And then we give you guys all the trades and investment opportunities that we see in the market based on this research. Now, it's not going to be an easy ride looking forward. I do think that we're on the right side of this. We're seeing the markets very clearly right now, and what's been going on here over the past couple of weeks has definitely been a lot more on our side of the trade than what some other people have been expecting. And we intend on continuing to find those opportunities and stay on the right side of the trade, however difficult that may be. If you're interested in checking out our service, our articles, our research, and get notifications to those opportunities that we see on the market, make sure to click on the link in the description down below. Now, I wanted to show you guys a tweet that we made, or a retweet that we made from Andrew Thrasher. And I just found this tweet absolutely fascinating because he looks at 2 measures of breadth, because he takes a look at the technology sector's market breadth, the NASDAQ 100's market breadth, and he gives 2 components to that. First of all, he looks at the short-term breadth. So this is the percentage of stocks above their 20-day moving average on the NASDAQ 100. So when it's high, all the stocks are above their short-term trend. When it's low, they're all trending down in the short term. So you get a lot of movements up and down on this. But then he also looks at the percentage of stocks above their 200 moving average. So this is a lot more long term. So when you've got a lot of stocks that are under their 200-day moving average, it means the index is very oversold. You tend to see this at big bottoms when the market has been trending down for a long time. And so what this basically looks at is how many times you've had a big recovery in the short-term breadth, so with the 20-day moving average, while most stocks are under their 200-day moving average. So in other words, how many times have we had a big broad recovery involving many stocks in the NASDAQ 100 while the index is oversold? And the answer is we've only had that 3 times in the last 23 years of data. Once in 2009, once in 2019, and once in 2020. Nothing is 100% in the market, but this type of stuff is very interesting to look at. I hope you guys enjoyed this video. If you did, don't forget to smash that like button, and of course subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.